Hello, this is Tom Cloud with this week's update on what's going on in my world. I want to start out by sincerely thanking you that watch and all the nice emails and calls we had about Hurricane Matthew coming through St. Simon's Island, and certainly we had a lot of destruction, but your concern and prayers are very much appreciated, and it was tough being off the island for 6 days and getting behind, but came back and our house was fortunately had no hurt whatsoever, so everything turned out great. Once again, thank you. I want to jump right into some of the questions that you as readers of Steve's newsletter are asking, and they're great questions. The first one is, why did China get the SDRs 3 weeks ago? And to this day, we don't know how much gold they have. They had to present an audited gold report to have clearance to get their special drawing rights at the IMF. So, and they've got it. They now constitute 12 point something percent of the basket. The United States dollars values 42 point something percent, and it's floated and evaluated between the 5 currencies. But here's the point. They've got their SDRs, they're operating, and yet we, the world, the public, doesn't know what their audited gold reserves are that had always been brought forward. But it's been 16 years since a new currency had been admitted to the IMF. So what you have here is speculation. What does it mean that they won't tell us the gold reserves that China has? Well, you can look at it one of two ways. Way number one is they have way more than people anticipated, and maybe more than the United States. And if they did, the number of gold known to exist might not add up, and then someone would be lying about their, how much they had in stock and their reserves. And certainly, many people have thought for years the United States doesn't have what they say they have. So that's theory number one: is the IMF knows they have more than the United States, or a lot more out there. They just don't want to shake the world up by putting their reserves out there. Number two, maybe China on purpose showed so much gold, got an audit on that, turned it over, got their special drawing rights, but they want the price to stay reasonably low for now until they accumulate all they want, and then they go to a gold standard as early as 2017 or 18, and then when that happens, they show the world the rest of their gold, plus everything else they've accumulated after that. And that really is something that I hadn't thought of in detail. But either one of these scenarios leads you to believe that it's not good for the U.S. and the U.S. dollar that is the largest currency in the special drawing rights. The other thing that came to our attention through this is, even though the United States value of the dollar is 42 point something percent of the basket, they have a 51% voting right. So basically you can say it wasn't 4 other currencies or 5 currencies, including the Chinese yuan, renminbi, that made the decision not to make it public. It was the United States. So that's the answer, to that, and we'll keep you abreast. I mean, it's certainly, to have a new currency after 16 years put in there, there's nothing, rules set in stone that they've got the ability to change and hassle and keep those numbers from us. But I can tell you that we're seeing, Steve wrote an excellent article, if you haven't read it, about the return of the volume of silver. We went into a 3-month low that I hadn't seen. Silver had been so hot for so long, and it's like it hit the wall this summer. And sales for U.S. Eagles, Canadian Maple Leafs, all these COMEX gold, silver bars, all of them went down at the same time. We were seeing gold actually tight. We were seeing central banks buying gold, large buyers buying gold, because you're not going to see central banks buying silver. They're going to buy gold. So not that we saw any big delays, but we did see some delays on some products for a few days. And this was mind-boggling considering how flat the market was. But now we've seen a big increase coming back in silver, and we're still in that lull the election lull of the last three elections, where whether you want to call it a gentleman's agreement between the Republicans and the Democrats, but basically you haven't seen the stock market, bond market, gold market, silver market, nothing for 3 months has done much of anything, and probably won't until the election is over here in the next 2 or 3 weeks, and then we'll start seeing where people are betting and wanting to put their money for the long term and the short term. The other thing email came in about from one of Steve's readers, is what did I think about Yellen backing off of raising interest in December at her speech in Boston recently. And it is kind of hard to believe. I mean, she did all this big talk back, and everybody's saying, well, they'll definitely raise rates in December. And yet now she's even talking about the potential that the Fed would buy stocks if needed. I mean, they're already creating money out of thin air. They're already buying bonds that don't sell by creating more money. And now they're talking about buying stocks. So people, when they talk about that, one thing you can be sure in any portfolio decision you make is they are planning on having to do it. That is a fact of being in the investment arena for 40 years that I can tell you. This is not gibbish, it is real. And at some point, they plan on an event in the stock market going down a lot and them coming in. And then number third question, and one that is I don't talk about much because I'm not, quote, a financial advisor, but I don't mind telling people what I do and percentages, and I don't mind telling you I talk to money managers every week. I mean, they are needing help. They don't understand gold. They know they need it. They want to put in their clients' portfolios. They need to know how it works on markups. What does it cost to get in? What does it cost to get out? What's the holding cost? And we've been through that with Steve in a webinar that you can go back and listen to. But here's the one thing I can tell you. I haven't talked to anybody, money manager managing from 15 million to over $1.5 billion, and some of them, most of them in 300 to 700 million range that they're managing, and they're trying to help their clients be diversified, to have their wealth in 6 or 7 different areas. So this is nothing new. This goes back to Ecclesiastes 11:2 in the Bible, to divide your wealth 7 or 8 ways, because no man knows what catastrophe will come upon the earth. So this is old school financial planning. This is real financial planning. You're not trying, stocks, bonds, and cash is a joke. That's not a portfolio. That's all going to go up or down primarily on the same things. You need things that go different directions. But I will say this, I would not have less than 1/3 of my portfolio in precious metals. I'm not going to give you a high-end number. I'm going to just say this, I would not have less than 33%. And the advisor asked me the other day, Mr. Cloud, how can you say that? And I said, well, let's just go from 2000 forward. If you want to go back to 72, since gold has been an investment, it's beaten stocks too. But let's just go to 2000. Gold's gone from 256 an ounce to 1250 or 1270 as I do this, for over 525%. Stock market's gone from 13.8 to 18. It's gone up 62% total in 16 years. 1,525, 162. Now you can add some dividends and you can say stock market's doubled in 16 years. But that's double, that's not 525%. And when you look at what's going on in the world today, especially the US, printing money out of control, deficits growing, $20 trillion a day, no way to pay it back, you've got to realize that gold and silver probably going to do better than stocks and bonds the next few years. So you go in there and you are responsible. If you were talked into a financial advisor telling you to stay in the stocks and bonds, then when they go down and the gold goes up, it's your fault, not theirs. You make the decision, it's your money. And all I can tell you is you need to get diversified. And if you don't like 33%, use 10%, use 20%, but please get diversified. So these questions were asked by you, the reader, and we're always happy to answer them. And once again, remember, When we sell you something, we mark it up over our raw cost, 2.5% for gold, 3% for silver. We pay the shipping and insurance, and we brokerage for you free when you're ready to sell it. We have the lowest round cost in the business. And for the ones of you that are large investors, our storage program, Cloud Hard Asset Storage, that we'll be happy to send you a internet brochure, is the best in the world. We're endorsed by Steve and many other newsletter writers, because when we're talking about 20 basis points, a guy has 100,000, he's paying $200 to store at IDS Delaware under our agreement, and he can be there under somebody else's agreement, paying 4 times that, $800 a year, and a lot of that money is going to the broker. We will not take a penny of your money for arranging the best brokerage fee deal in the world. So hopefully you can give us a call, and we'll talk to you about different product. And if you don't have a precious metals IRA, we'd like to walk you through that if you're interested in having a self-directed precious metals IRA. So hopefully you give us a call at 800-247-2812. That's 800-247-2812. And if you're not getting my free email bullet, just sign up on Steve's website. We don't share your email with anyone. So give us a call, and we'll have you to answer any of these questions. And please keep emailing us through the website or through Steve or directly questions. We'll deal with them next time. Till next time, this is Tom Cloud signing out.